All right, good afternoon, everyone. My name is Danae Aber. I'm the Executive Director of the Louisiana Rural Health Association. Thank you for joining us for the Rural Health Clinic Cost Reporting 201 webinar. LRHA is happy to host this webinar presented by Healthcare Business Specialists as the second of this two-part series. This webinar will cover the more advanced RHC cost reporting information. If you missed our webinar last week on the basics of RHC cost reporting, you can find the recording on the education page of our website. This webinar is also being recorded and will be available along with a copy of the slides on the education page as well. I will drop a link to that page in the chat in a minute. Your line should be muted for preventing background noise. If you have any questions, please enter them into the Q&A box at the bottom. After the webinar, a survey should automatically open in your internet browser. We do ask that you please complete that survey as it helps us to continue to improve for future events and identify future education topics. So with that, I would like to welcome Mr. Mark Lynn. Mark has served since 1989 as the president of Healthcare Business Specialists, a healthcare consulting firm based in Chattanooga, Tennessee. Mr. Lynn is trained as a certified public accountant and is also a certified rural health clinic professional, a certified cost report specialist. And in his role at HBS, he helps to prepare Medicare and Medicaid cost reports for RHCs, helps physician, nurse practitioner, and physician assistant practices become certified as RHCs, and works with RHCs in developing and implementing emergency preparedness plans in compliance with conditions of participation, as well as conducts program evaluations for RHCs and works with RHCs on reporting and disbursement of COVID-19 provider relief funds in accordance with DHHS guidance. Mr. Lynn is a frequent speaker at national and state meetings regarding rural health clinic matters. So thank you so much, Mark, for being here, and I will hand it off to you.
Okay, thank you, Danae. I appreciate it very much. And welcome, everybody. Our prayers are certainly with Louisiana, with all the tornadoes that went through. They're headed this way. I'm in Orlando on vacation this week, and they seem to be hitting us just as we're getting started today. So hopefully we will not have Wi-Fi issues as we get through this. Here's my contact information. If you do have questions or need to get a hold of me, please feel free. You can text me on that number. That's my cell phone number, and I'll be glad to respond at any time. The disclaimer, everything is up to date as of today. As we'll be talking about cost report issues, if you have specific questions regarding those, I would contact your cost report preparer before you make any changes. And some of the things we'll talk about will affect your taxes as well. So your tax accountant should be aware of any sort of changes that you try to make as well. This will be general information related to rural health clinics, and we'll sort of pick up to where we left off at the end of the 101 session here just in a second. Here's the agenda that we will be looking at. I will do a little bit of section on the impact of the Consolidated Appropriations Act of 2021, because it does have a major impact on cost reporting and how you prepare the cost report and the impact of it. Bad debts, that's where we left off last week. We'll talk about that. We'll also talk about the types of cost reports. You can file a low, a no, or a full Medicare cost report in Louisiana. Louisiana does require you to actually file a full cost report to the state of Louisiana for Medicaid purposes. However, for Medicare purposes, you could file a low utilization or a no utilization cost report to Medicare, and there are certain situations where that would benefit you. So we'll tell you what those are. Then we'll go into some of the emerging issues with rural health clinic cost reports. There's things like nursing homes, Botox, all these non-RHC services, clinics that have multiple clinics and different MPI numbers, how you deal with that. We'll go back and talk about owner's compensation. How is allowable owner compensation computed? And that will depend upon the type of entity that you have. And then the CAA impact on related party transactions. Those are those are something that before we didn't have to worry about too much, but now they're going to hurt our bottom line if we don't watch out. So the biggest change, and you can tell from the video here that I am old as the hills. I've actually attended the first RHC session back in 1992 or 93, and I've been to pretty much every single fall and spring institute with an NARHC since then. And we always talked about the rates getting increased for independent RHCs. It never did happen. Well, it finally did happen with the Consolidated Appropriations Act of 2021, and the Medicare upper payment limits are dramatically increased for independent RHCs. That's going to have a tremendous effect on the reimbursement for the independent RHCs. Unfortunately, that higher rate came at a cost, and that cost was provider-based RHCs, which are typically owned by hospitals. All of those are subject to a cap. Some of them were grandfathered. Even if you're grandfathered, though, you don't get away with not having a cap. That cap is just based upon your expenses in the last cost report that you filed in 2020 or your first full year in the RHC program, if you were one of those clinics that were grandfathered that had an 855A filed by 12/31 of 2020, but you weren't officially a rural health clinic till maybe 4 or 5 months later into 2021. That you would still be a grandfathered RHC. It's just you would have a different time basis for when that was established. Here's the FAQ from Medicare on if your RHC is grandfathered or not. So if you're a part of a hospital chain, you'll definitely want to look at that. You'll also want to look at if you have more than one RHC. In fact, I had a conversation this morning with a hospital that had several RHCs, and they were planning on moving the RHC to another location where they only had one physician in one location, but they had 7 doctors, and they had a lot more volume in that one. And that particular clinic had a really good rate. So we're going to move that clinic over to an area where I think their rate was $220 a visit. That rate will be subject to growth caps every year. So their cost per visit, if it goes to $300 a visit, Medicare will not pay them $300 a visit. They're going to pay them $220 a visit plus some type of inflation factor. So every rural health clinic is subject to some type of cap, and that was not the case in the future. So here's a report from MedPAC going through who's subject to the national statutory limits, which I will show you in a minute, and then those that are subject to the grandfathered cap. That is a site specific. Every grandfathered RHC will have a different cap based upon their actual cost. Here are the national statutory limits. You can see they go up by $13 a year for each year, starting in 2021, where we were at 100, and 2022, where our current year, it's 113. And for 2023, it's going to go up to 126. One thing to remember is, number one is, these are the caps on what's called the all-inclusive rate. That all-inclusive rate is not really all-inclusive because it doesn't cover laboratory services. So all lab service, including the 6 required lab tests to be a rural health clinic, you can bill those and get paid either fee for service for those, or you can get cost-based reimbursement for that. Those are not a part of your all-inclusive rate. Same thing for technical components. You can bill those to Medicare Part B, and you can get paid fee for service for that. If you're a CAH or a hospital, you can bill that on a UB04. And if you're a PPS hospital, you're going to get paid fee for service. If you're a CAH, you're going to get paid cost-based for that. So chronic care management services, and then telehealth. Except for, and there's always exceptions. It's always confusing to listen to these presentations because we say so much and we keep telling you about exceptions. So telehealth is not covered under the all-inclusive rate, except beginning in 2022. mental health services provided via telehealth are a part of that all-inclusive rate. And then it's always been hospital service. If you do anything in the hospital, that is not a part of that all-inclusive rate. And why that list is important is you'll have to keep good records on these items here, because we're going to need to exclude that from the cost report as a non-allowable expense. Also, people get confused when we say the all-inclusive rate. Medicare is going to pay you $126 a visit. They don't really pay you $126. They actually pay you, there's an 80-20 split. The patient has to pay 20% of your charge to that patient. There's no limiting charge like there is for Medicare Part B. So if you charge $200 for a 99213, that Medicare patient's going to have to pay a $40 copay for that. Also, Medicare doesn't really pay you 80% of that. They actually pay you 78.4% because there's something called sequestration. Medicare reduces your payment across the board by 2%, and that sequestration is going to go up to 6% starting January the 1st, unless something changes. So get out there and lobby. Everybody thinks it's a done deal, but it's not in writing yet that 6% will not go into effect on January the 1st. So that's your national statutory limits for your rural health clinics that are not grandfathered. The problem with these caps is they're going up to $190 a visit by 2028. You are not going to be able to, if you're like most independent RHCs, you're not going to be able to keep your cost per visit up that high. Otherwise, you're going to go out of business, because these caps only apply to original Medicare patients. That's probably 20 to 25% of your business. You probably have another 20 to 25% of your business that's Medicare Advantage plans that are not required to pay this rate. Some of them will. You'll want to reach out to those Medicare Advantage plans and say, hey, we're a rural health clinic. Here's our rate letter. Will you pay us your rate? And some of them will. Most of them won't. So keep that in mind, is that if you think you're going to be able to get $190 a visit from Medicare in the future, it will be very hard to get that. You will probably, if your cost per visit is $190 per visit, unless you're a hospital where you're allocating a lot of hospital overhead to that clinic, the independent RHCs are probably not going to see anywhere near that high of a reimbursement. It was actually very easy for cost report preparers like me back in the past, because the cap was $86 a visit, and a typical rural health clinic cost per visit is usually around $130 to $140. You were capped at a cost that's way less than what the actual cost per visit was. So we could typically get our information at the very last minute, fill it out, and it would not have any effect on you whatsoever. And a lot of you guys did wait to the last minute. You can't really do that anymore, because there's a lot more to this cost report now, because these caps have increased so much. So the game has definitely changed. Some of the strategies that you'll want to take to keep your cost per visit up is, if you're starting up a new clinic, to know what the different structures, the ownership structures have based upon owner's compensation, those sort of things. And we'll talk about that in a minute, what is going to be best for you guys to set up. I can tell you right off the bat is sole proprietor is not the way to go, because if you have a sole proprietor for a rural health clinic, that clinic, if that owner dies, then the RHC goes away. It's not transferable at that point. So you'll want to set up at least an LLC. That's the bare minimum that you'll want to. And we'll show you the benefits to that in a minute. Medicaid, you'll want to know how Medicaid works in your state. In Louisiana, they typically don't use the cost report to actually set your rates. They're based upon the area that you're located in, and they'll set your Medicaid rate based upon that. But you'll want to get with the group there. Lindsay Talley is the administrative assistant that we work with all the time. And you will have to file full Medicaid cost reports to Medicaid every year. That is one of the requirements in Louisiana to do that. If you're brand new to the RHC program, you just passed your survey, you're going to get a tie-in letter that typically comes about 4 to 5 months after you've been certified as a rural health clinic by the Dallas region office. If you were in the Atlanta region office, you would get that letter in about 2 to 3 weeks, but it takes 4 to 5 months in the Dallas region office to get that letter. And you can't really bill until you get that letter. So that's been a problem in the Dallas region office for as long as I can remember, of why it takes 6 months to get a tie-in letter it's a 1-page letter with a 6-digit number. Why does it take them so long to get that? But that'll have a date that you were surveyed. Your first cost reporting period will begin with that date that you were surveyed. Even though you probably can't bill for a big portion of that, that will be your cost report period. And then once you become an RHC, you want to educate your staff about the cost reporting process of what data elements you have to keep up with, your cost centers. You'll want to have a chart of accounts that matches the Medicare cost report as much as possible. And you'll want to know how to do a visit count, a CPT frequency report by provider, not by payer, but by provider, in order to count your visits. During the year, you'll want to keep up with your cost and prepare interim cost reports just to see how you're doing and do a strategy to maximize what your cost per visit is, so that you can hit those caps. And that may require you to accrue some expenses. You are required under the Medicare regulations to use accrual basis accounting to do these cost reports. Frankly, we did a terrible job of accrual basis accounting. And I think because we were so far below the caps, everyone figured out it didn't really matter if you used a lot of you guys use cash basis because you're small clinics, and that's the way the IRS works. But for Medicare purposes, you do need to do accrual basis accounting, and that will so you'll want to work on improving those internal accounting methods that you have. Again, hospitals, just like we had this conversation this morning about moving a clinic to a place where you had higher volume and move that higher rate so you get better impact of that. You've got some movable chess pieces. If you're in a hospital and you have all these different RHCs, you'll want to use them in the way where it maximizes your reimbursement impact. So here's the impacts of these higher caps. Number one is you're going to be much more strategic and much more forward thinking than you've ever done before. There are large paybacks to Medicare now that I've been seeing. Before we never had to worry about that because the caps, you're so far below the caps. Now I see $10,000, $15,000, $20,000, $30,000 paybacks to Medicare all the time, which we didn't see in the past. Again, you're not going to be able to keep, if your independent RHCs are not going to be able to keep your cost per visit above the caps like they did in the past. Also, for your provider-based RHCs, you really have to go back and see what your 2020 cost report was and what your cost per visit was for that time, because if your cost per visit goes dramatically higher than that, you're not going to get reimbursed for that from Medicare. I had a hospital call me last week, and I think they had a cost per visit of $90 back in 2020, and now it's $220. And they're like, well, how do we get our $220 a visit? And my response was, you're going to get, you're not going to recoup that money the way the rules are now. Cost reporting will come under much more scrutiny than it did in the past. Again, Medicare knew that they had a good deal with you guys. And basically when we send in a cost report, within a few days, these independent RHCs would get what's called an NPR, Notice of Program Reimbursement, and they would accept what we filed to them immediately. I can see them becoming much more scrutiny of the cost reports in the future. time records, especially for productivity standards. We talked about the 4,200 visits for a physician, the 2,100 visits for a nurse practitioner and a PA. You'll want to keep good time records for them, because you'll want your FTEs, your full-time equivalents for those physicians, to be as low as possible. You only want to keep up with time that they were seeing patients, charting patients, and treating them. That's going to be very important. So they won't be a 1.0 FTE. They may be a 0.8 or a 0.7. That's good for you guys. You want that productivity, that FTE, to be as low as possible. And then keeping good records on non-RHC services or services that are not computed in the all-inclusive rate. Now, preparing cost reports, there's a whole menu of services that aren't included in the all-inclusive rate that you need to keep up with those costs. So number one is we keep up with the direct expenses of those, and number two is we allocate expenses to those particular areas on the cost report as well. And again, counting visits, I always say counting visits is more of an art than a science. And we'll have to have a really good understanding of counting those visits, make sure we don't double count. We talked about this week in Louisiana for Medicaid, they use a T1015 code to tell Medicaid to pay the RHC rate. And you also have a CPT code. The CPT code is 99213 or 99214. That's what you use for coding, but for billing purposes, uses a T1015 code. And we had a clinic that was double counting those. And so you'll want to not make that error, because that error costs thousands and thousands of dollars of reimbursement. Okay, going back to where we left off in the 101 session, Medicare bad debts. Medicare will pay you 65% of any uncollected Medicare copay and deductible if you do certain things. The first thing is it has to be billed to Medicare Part A on a UBO4. That's your, and this is the only thing that this particular thing covers is you get 65% of what you write off. So let's go in, and here are the rules. This is from Noridian, has a listing of reimbursement rules. I realize that's not your MAC, but they do. They have a really good listing of what has to be done. So let's go through exactly what this is. Your Medicare copays are 20% of charges. Your Medicare deductible is $233 in 2022 and $226 in 2023. Only stuff billed to Medicare Part A. So none of any of your hospital stuff, anything billed to Medicare Part B, fee for service, is not going to be allowed. So nothing else. You have to try to collect for at least 120 days from the first bill, and you must treat everyone the same. So if you turn over your self-pay or your commercial patients to a collection agency, you have to turn over your Medicare patients. It must be written off in the fiscal year of your cost report. So if you guys have a 12/31 year end and you've not written off any bad debts this year, you need to go, as soon as you leave here, start looking at your accounts receivable, get an aging, look at those Medicare patients out there that have copays and deductibles that you don't think you're going to collect. Maybe some of them are deceased. You'll want to write those off and cease your collection efforts, and you'll get 65% of that as extra money on your Medicare cost report. So this does not include anything you bill to a hospital, any technical components, your Medicare Advantage plans, patients. These are not a part of this bad debt as well. So again, it's only Medicare original patients is where you get this money. You have to try to collect for at least 120 days, sending them out 3 or 4 bills, maybe make some phone calls to them. Those are going to be reasonable collection efforts. And you have to get a bill out to the patient within 45 to 60 days of service. So that comes from the Federal Register. So you'll want to do that if you're going to collect that money. You will have to use an Excel spreadsheet to submit this, and we will have to submit this as a part of our cost report submission. There's two types of bad debts. There's a regular Medicare patient who only has Medicare, and then there's another type of patient called a crossover or dual eligible. That patient has Medicare primary and Medicaid secondary. So you want to keep two different logs for that. So here's what the log looks like. It's only, I say only 10 columns because they have a new form that has 25 columns in it. You do not have to use that new form yet. You can still use the older form that only has 10 columns. They've not told us to change that yet. What a dual eligible is when maybe you have a Medicare copay that's that $40. It gets crossed over to Medicaid, and Medicaid says, well, your Medicare rate was such and such, and we're going to pay you $10 of this copay, but we're not going to pay you any more. You have $30 that you did not collect of co-insurance. That $30 you can put on this Medicare bad debt crossover schedule, send to Medicare, and Medicare will give you 65% of that. You don't have to try to collect that. The 120-day rule does not apply to these. You don't have to try to collect, because if a patient is on Medicaid, they are by definition indigent. So keep that in mind. Also, if you do have Medicare patients and you don't want to try to collect, you don't want to go through all those collection efforts because Mrs. Jones does not have enough money to pay you that, you can set up an indigent policy that says if they're below poverty level, and you can say 300% of poverty level, 400% of poverty level, or whatever, you can set up a policy like that, and you can go ahead and write those patients off immediately as well. But you will need to get some proof that Mrs. Jones is at 300 or 400% poverty, so you have to collect some information from the patient in order to do that. So that's something you can do. Also, this is a clarification from CMS that we received for chronic care management and virtual communications. You can claim that on the Medicare cost report as an allowable bad debt as well. That's something that's new to us. Here's some links for you guys. The first one is just a Medicare, a bad debt policy. You never call it a Medicare bad debt policy. I almost made that mistake there, because you don't have a policy for just Medicare patients. You have to have the same policy for everybody. So you have a bad debt policy. So there's your policy. And then there's two different Excel spreadsheets. One is for a Medicare only patient, and the second one is for a Medicare, Medicaid crossover dual eligible patient. So you'll want that. If you've never heard of this before, how far can you go back? You can go far back as long as where you have records to go back. So if you've got good accounting system and you have all of your records back 5, 6, 7 years, you can go back 5, 6, 7 years. If you were a rural health clinic at that time, if you build it to Medicare Part A, if you meet all the criteria that I've just told you about, you can go back as far as you want to. It is the date that you ceased collection efforts and you wrote that out of your accounts receivable system is when you have a bad debt. So if somehow maybe one of your patients won the lottery and they came back after you've written them off and they paid you, that's called a bad debt recovery, and you would have to show that in your bad debt listing that actually reduce your amount of bad debts if you had that. Okay, moving on to the next subject is capitalization and depreciation expense. This is going to be more and more important. I know in the past, we've like I said, I had an easy job in the past. We basically passed on converting your depreciation to straight line depreciation. That is the requirement for Medicare, but it had no impact on the amount of reimbursement, and it would take 3 or 4 or 5 hours to do it. So we would typically pass on that. We're not going to be able to do that in the future, because it will have an impact on your reimbursement. For Medicare purposes, you have to use straight line depreciation. You can use up to a $5,000 capitalization threshold. I would recommend that. So if you go and buy, maybe you buy an exam room table and it costs $4,500, expense that in the year that you have, if you have a $5,000 Medicare capitalization threshold. So you'll want that capitalization threshold to be as high as possible. That way you can just expense all these minor movable equipment purchases that you have. If it's more than 5,000, then you're going to have to use the AHA guidelines. That's the American Hospital Association. They have a little booklet that you can buy that we have, and it basically tells you what the useful lives are, and we'll have to depreciate it over that time. So that's going to be more and more important as we go along. Accruals, again, accruals of expenses is going to be very important that you accrue compensation to owners. If you do accrue a bonus to one of your ownership group and you're a corporation, then you're going to have to liquidate that, write a check for it, cash that check within 75 days of year end. If you accrue expenses to non-owners, then you have up to 1 year to write that check and cash that check of accrual of expenses. Things like pension plan contributions for 2022 that were not paid until 2023, that would be good. You can also accrue your payroll expenses if you, depending on, you pay your employees every 2 weeks, depending on the day when you actually pay that. It could be in 2023. If it is, you can accrue the number of days that were in 2022 as a part of that. Also, if you have employees that accrue vacation or sick pay, you'll want to go and make that computation as well so that you can put that on your books and claim that expense, because it's going to be extremely important that you do that. So also take a look at your check register in January and February. And if you have expenses that were for December, but you didn't get around to paying and you don't really have an accounts payable system, then we can pick that up and accrue that on your cost report, and you'll be able to get credit for that expense in 2022, because it's going to be important that we pick up every bit of expense that we can. We want to actually try to get your expense per visit to over $126 a visit if possible. The reason why we want to do that is that's going to help your cash flow in the next year, because what Novitas will do is, right now, even though our cap is only 113 in 2022, you probably think, oh, it's only get to 113. That's great. Well, if you can get it to 126, when Novitas sets your rate at the beginning of 2023 for 2023, and they see your cost per visit is above 126, they're going to set your interim rate at 126. If they see your cost per visit is only 114 or 115, that's going to be your rate for 2023. So you want to try to always hit the next year's cap in order to maximize your cash flow, in order to fund spending more money that year. It's hard to spend money that you don't have. My wife is pretty good at it, but as a business, it's really hard to do that. So if we can accrue as much expense as we can and claim as much as we can for 2022, that's the smart thing to do. We don't have to worry about the PRF funds. If you're using PRF funds, do we have to pull that out of the cost report and not claim it on the cost report? Medicare has told us no, you do not. Same thing for all that I forgot what it is, SBA, the payroll protection money that everybody got. You do not have to offset those expenses in there. Here is our compensation for owners. And this is important, and it's probably too late for most of you guys to do anything about this unless you're planning on starting up new rural health clinics with new entities. Or if you're a sole proprietor, I would tell you convert as soon as you can to become an LLC. If you're a single member, that's fine. But you can transfer that single member LLC to somebody, to maybe your children or to your spouse or whoever. But a sole proprietor, if your sole proprietor passes away, that RHC goes away under rural health clinic regulations. LLC, multiple member, those are good. The reason why this is good is there's something called value of services, and value of services is I'll show you an example of what value of services means in on the next slide or two. But if you're a corporation, it's based upon your actual compensation paid and accrued within 75 days of your end. So you have to pay that money. If you are an S corporation, that doesn't really change how your value of services or actual compensation computation is done. So you'll want to make sure that you look at that. Also, some states don't recognize value of services. So you'll want to keep that in mind as well when you're dealing with in Louisiana, really your rates aren't really based on cost reports, so it doesn't have as big effect on you guys as it would in other states where that could affect you. So here's just a summary. If you're sole proprietor, an LLC, value of services can be used. If you're a corporation or a sub S corporation, a lot of times I tend to put it on there because that's the most conservative thing to say. Is I always tell those you'll definitely want to pay as much compensation as you can in either one of these. And here are the rules. If you want to read those, it's like section 907 of the HIM 15 manual. It's about 15 pages long, so it's really not too bad. Here is a section from it. It talks about the value of services. Such amount may not be represented by actual payments. That's great. That means we don't really have to pay this money in order to put this on the cost report as an allowable expense. So we'll show you how this works here just in a second here. Here is in those regulations that we just showed you, there is a guideline for allowable compensation for physicians. They only do it for physicians, and it's a little bit dated, so you'll have to update these numbers. So it's typically, the max is usually around 350,000 or so by now, but depending on which region that you're in. A lot of times we use MGMA standards, or we use WIFLE benchmarking reports from rural health clinics. And so here is what value of services looks like. It's just an adjustment that we make on the cost report. You don't write a check to the owner. We don't report it to the IRS as taxable income, so you don't pay taxes on it. And so here's our example. Steve, new clinic MD. He had 5,000 face-to-face encounters during the first cost reporting period. However, due to revenue cycle issues, the Dallas Region Office didn't do the tie-in notice until forever. So we couldn't bill as a rural health clinic for 5 months or longer. Dr. New clinic, he only received $50,000 in compensation during that period of time. But really, he saw 5,000 visits. You multiply that by our WIFLE benchmarking study of $75 per visit. That gives us, he was actually worth $375,000. We'd already included $50,000 in our cost center one. So we make an adjustment to increase that cost center one by $325,000. And so our net allowable compensation now for Dr. New Clinic is $375,000. And that, of course, raises our cost per visit to where it should be, and we're not punished by them not issuing the tie-in notice as soon as they should. So I'm gonna get in trouble for that, aren't I? But it's annoyed me for 25 years that they take so long. Related party transactions. This is going to be important too. I stuck the Oregon rules up here because it was a very easy way. It's basically the same rules for every state. A related party is an individual or organization that is associated by control, by money, by common ownership, or by relations, your spouse, your son, your daughter, your father-in-law, a close relation like that. What happens is the related party rules basically treat the cost incurred from the related party as if they weren't, as if there really was no related party. And what that means is if my wife owns the building and I want to rent it to her and she wants $500,000 in rent, and I say, sure, honey, here's $500,000. We'll pay you the $500,000 that you want for rent. Medicare says, no, your building is a little bitty, 300 square foot building, and it's not worth $500,000 for you to do this. We're going to pull that $500,000 out, and you can put in what your actual expenses were. Well, you can put in your interest expense, your property taxes, your repairs, that sort of stuff. You can actual expenses you can put in there, but we're going to wash away that related party transaction. So keep that in mind. This is going to be more and more important in the future just because those caps are increased. Remember before we were $40, $50 below the cap. So you could pay yourself a really high rent and that would save you on taxes and would not affect your Medicare cost report whatsoever. That is no longer be the case. Here's an example that we're going to give you is we charged $200,000 in rent. Our actual cost was $50,000, and we disallowed $150,000 on the cost report. In 2021, that dropped our cost per visit down to $108 a visit, but the Medicare cap was $100. So that transaction had no effect whatsoever. Let's go into 2022 when the rate goes up to $113, and same exact transaction cost us $15,000 in Medicare reimbursement. Because if we changed it around, if we changed our assumptions to where instead of charging $200,000 in rent, we only charged $50,000 in rent, and our actual cost was still $50,000, we would not disallow any. Now, what we would do is pay that owner $150,000 in compensation. So he or she is going to get the same exact amount of money. It's not going to be as rent. Now, this is one you really need to talk to your tax CPA about and make sure that you're not shooting yourself in the foot by doing something like this. But and you may want to take a look at year end. So you may sort of do your rent versus your salary by the end of the year. That would be extremely something that could actually save you some money on your cost report. Emerging issues, nursing home. There's a lot of people that are going around and running nursing home visits through the rural health clinic. Don't sure if that's exactly what the intent of the rural health clinic program is, but it's certainly not against the law. We've had attorneys look very closely at it, and they've said, nope, there's nothing in the rules. And CMS has said, nope, there's nothing in the rules against it. Now, if this thing continues to grow, they probably will take a look at doing something to sort of curtail it a little bit. But the problem is the increased volume of these nursing home visits makes it extremely hard to keep up with your costs, keep your cost per visit very high. I know we had one the other day I was working on, and our cost per visit was coming in at $60 or $70 a visit because we had so many visits in there. Also, keeping track of your provider time schedules and which nursing homes they are and who's making those rounds for FTE purposes is sort of a nightmare. So you'll want to keep up with that as well. Mental health services in rural health clinics, we're seeing a lot more mental health, which is good. The problem is in the law, it says that an RHC cannot be primarily engaged in the treatment of behavioral health. That's the 51% rule. So you'll want to be very careful and watch that during the year, that you don't go over that. Over 50% of your business is mental health, because then you're not in compliance with the RHC program. I'm not sure if that's a cost reporting issue, but it's something that we see all the time. You'll want to keep up with those visits. Botox, we do see a lot of this. People want to get into these sort of spa type stuff that's not covered under the Medicare program. That's perfectly fine. You don't have to do this during non-RHCs. You don't have to set up non-RHC hours to do that. But if you do it, you need to keep up with the direct cost. So how much did you pay for that Botox? How much time did your nurses spend in doing those types of services? You'll want to keep up with them and put it in a separate general ledger account so that on the cost report, we can put it in a non-allowable section of the cost report and allocate overhead to that, because Medicare is not going to cover that. We also have what I call the urgent care models, where you have an urgent care center, they have one tax ID number and they have one MPI number, and that's the way they want to do business. In the rural health clinic program, you can't really do that. You have to have, each rural health clinic has a separate MPI number, and they will be filing a separate cost report for that until you get to the point to where you can actually consolidate those. But at the very beginning, you're going to have separate cost reports for those for at least the first couple years that you're a rural health clinic. So you'll want to have a robust accounting system that will keep track of your expenses by location and will keep up with your CPT codes by location and by provider. Also, the credit balance report. There's a credit balance. This is not an advanced subject at all, but every quarter you do have to fill out what's called a quarterly 838 report on credit balances. Most of you, 99% of the time, the answer is going to be 0. You'll need to fax that into Novitas. Make sure you fax it into the correct contract number, because Novitas has 2 different contracts. So make sure that you get the one for this region and send it to the right fax number, because if you don't do this, Medicare is going to cut off your payments. Real quickly here, we're going to go into 3 types of cost reports. There's a no utilization cost report, a low utilization cost report, and a full cost report. And no utilization is great for pediatric offices. You don't have any Medicare, you can just send in a report to Medicare saying we didn't have any utilization, we're good. For Medicaid in Louisiana, you're still going to have to do a full cost report with them, unfortunately. Low utilization means if you got less than $50,000 worth of interim payments from Medicare, you can do very similar, where you just send in a 1 or 2 pager to Medicare saying we don't want any money from you, and we'll take your rate. That can be very useful if you get your cap set at $126 a visit and you figure out that your cost per visit is coming in at $95 a visit. You can file that low utilization cost report and say, well, I'm good. Y'all keep my rate at 126 and we're happy with it. So there's a little bit of strategy there that you can use with that. And then if you get more than $50,000 in payments in a year, you're going to have to do a full cost report. The problem with these low utilization cost reports is they're not going to pay you for your flu and pneumococcal. They're not going to pay you for your bad debts. You're going to basically accept what Medicare pays you during the year. And that's what you're going to get. Here's just some summaries of this. Here's your full cost report. Again, the fees are going to be higher, but you are going to get reimbursed for flu, pneumococcal, COVID, all that sort of stuff there. That's my reminder that I need to be stopping soon. So I will try to get through these last few slides pretty quickly and give us a little bit of time to answer questions. Full utilization. You get everything there. With low utilization, again, you don't get all the money. All you have to do is send them a balance sheet and a profit and loss statement. Very simple for those. So those are the options that you have. Again, 50,000 is and that's net Medicare payments. If you run what's called a PSNR report, look to the bottom line number that says net Medicare payments on there. And that is the number. If that's actual payments to you. If it's less than 50,000, then you would qualify for a low utilization. Couple things to do: talk to your tax accountant, talk to your cost report preparer, and get your PRF funds spent. That's going to be extremely important. If you're a 1231 year end, especially, you'll want to do these things. write off your bad debts. We talked about that. That needs to be done before the end of the year. Also, these PRF funds that you guys have, most of them have a 12/31 year-end deadline. In fact, I just listened to a webinar before I got on today with you about spending those PRF funds. So you'll want to do that. Look at your cash accounts, see how much cash you have, talk to your tax accountant, and spend as much as you can. I had a conversation with a client this morning about they had a bunch of cash because they got behind on billing, and this year, and he was where your cost report is truly a cost report. There's no revenues on it. He was asking me, well, I'm going to show a big profit. Is that going to hurt my cost report? No, it has no effect on it because we only put cost on the cost report. So review your cash. You probably want to do a calculation of how much what your cost per visit is now, because if your cost per visit is way above the cap, you may want to save back some of that money and spend it in 2023, trying to get you up to a higher cap in 2023. So again, there's a lot of strategy to this that you didn't have before. Fund your retirement plans. There's some plans, if you do like a 401k, that has to be funded by the end of the year. Other plans are when the tax return is due, you can actually do that. And then look at your related party, talk to your CPA about your related party transactions and see if there's ways that you can change that to make it more attractive to you. Here's some timelines of stuff that you need to do all year long. Keep up with your flu, pneumococcal, COVID, MAB logs. That's something that should be fluid and on an ongoing basis all year long. Keep up with your Medicare bad debts and write those off on a monthly basis. It's a whole lot easier than trying to do it all at once at the end of the year. Every month, do your time studies for your physicians, nurse practitioners, and PAs. You want to do, if you do it the way Medicare wants you to do it, you do one a month for 1 week every month. You can do it for 1 week every quarter. I have seen some MACs say they would accept that, but you'll want to work on that. At year end, you guys, if you're not set up with IDM yet, and you don't have an authorized cost report preparer, everybody files their cost reports electronically now. You'll want to do that, and then talk about your year-end bonuses as well. And there's just more on the deadlines. I think we've covered those before. There's some links on our website at ruralhealthclinic.com on cost reporting. Get professional help. And one of the best places to go is the National Association of Rural Health Clinics. They have a listing of consultants who are familiar with cost reports. So you see us, we're there, yay, us there. And then HSA, Julie Quinn, Chris Christopherson, they're fantastic. They've been doing cost reports forever. Inquisic, Jeff and Patty, and then you'll see North American, where Charles and David James. The people that go to all the meetings, if you see them at the meetings, they understand rural health clinics. It's not like I went on the AI bot yesterday that said how to prepare a cost report, that new thing that's out there, artificial intelligence. The AI bot had no clue on how to prepare a cost report. I felt job security after I did it. So get with these professionals. They are going to be very helpful to you. Okay, I finished 4 minutes over what I wanted to, but I think we still have 6 minutes to answer questions. So Danae, if you'll read them off, I'll try to answer them.
Yeah, so we do have a couple. So the first question we have is, can you please summarize again why an RHC over time may not likely be able to reach the max reimbursement amount? You reference Medicare Advantage programs as part of the problem.
Yeah. The reason why you will not be able to is you're going to get, let's say you get $190 a visit from Medicare Part A. The way the cost report is, you take your total expenses by your total visits. Well, in that total visits, it's not just Medicare Original Part A, it's also Medicare Advantage plans. So if Medicare Advantage plans are paying you $115 a visit, and Medicare is paying you $190, and your Medicaid program is paying you, $125 a visit, and your commercial insurances are paying you maybe $115 a visit. When you add that all up, there's no way to keep your cost per visit up to one. If you're spending $190 every visit and you're only getting paid $190 a visit on 20% of your business, you're going to have a big hole in your finances. You're going to lose $400,000 or $500,000 a year if you do that. So that's the reason why you mathematically will not be able to keep it up to 190 per visit. So I hope that explains. That was probably clear as mud, but that's the math behind why you can't do that.
Gotcha. So the next question is, if a quote value of service adjustment is made in 2022 for the very reason you gave, example, cash flow problem as the example where the patient was seen but not reimbursed until 2023, and the owners don't receive compensation in 2022, but does get paid in 23 when the cash comes in, is there any type of adjustment made in 23 to counter the 2022 value of service adjustment?
Yeah, no, there's not. It's not like an accrual of expenses, which that's what they're sort of getting at, is if you accrue expense in one year, then you have to sort of unaccrue it the next year, and reverse it. It's not like that. You'll do that same computation in 2023 the next year to see how much cash you actually collected and then what your value of services were, and it would go from there. But yeah, that's a really good question, but no, there is no reversal of that the next year.
Okay, I'm reading the follow-up to see, you might have answered the follow-up. Is it better to do the value of service adjustment or treat the compensation as an accounts payable, realizing it has to be paid 75 days into the new year?
Yeah.
It seems that if you take the adjustment in 22, you wouldn't be allowed to also receive the benefit of an actual expense when it's paid in 23.
Yeah. So I think I just answered that too. It's really not an accrual of an expense. It is a computation of what the value is in that particular year. But she does make a good point. If you accrue a bonus in 2022, let's see, say I give Danae, you're going to get a $75,000 bonus, and we're going to pay it to you by within 75 days of year end. You will have to reverse that accrual the next year. So whoever's asked that question is making a really good point. Is the accrual sort of help you as a one-time sort of bump up your cost per visit? You get a one-time bump on it, but the years after that, you end up reversing it and then having to accrue it again over and over again. So it becomes a never-ending cycle, but your cost per visit is $75,000 higher than it would be always going forward. Okay.
All right, so that's all the questions that were in the Q&A.
Okay, those were really good high-level questions there.
Yeah.
So you're good.
Thank you so much. So I think you answered somebody's question because he said thank you.
Yeah. Okay. Very good. Okay.
All right. Well, since we are right at the top of the hour, I'm going to go ahead and do our wrap up. Any last thoughts, Mark, before I wrap us up?
No, thank y'all very much for having me. Like I said, just hope everybody's safe from the tornado, and hopefully it's not coming our way, because I'm going to Epcot right now. So thank y'all. You'll have a great day.
Thank you so much for joining us. Please complete the survey when you exit the session. The recording will be available on our website in the next couple of days. Always feel free to reach out to us if we can be of any assistance. Mark's contact information is there on the screen. So thank you so much and have a wonderful day.